Hello, everyone. Good afternoon. Thank you for joining me again. We've seen current account deficit in the United States came out at $218.4 billion in the third quarter. That represented 3.7% of US GDP in just one quarter increased debt. So the United States, on some levels, is actually getting poorer while the stock market continues to rally. Well, continues. It seems to have come to a bit of a standstill. I do think we've had a good bounce, and it's nice to see a bounce in markets, but bounces are part of a bear market. Now, I've been hearing that some people aren't sure about how to handle a bear market or if it's a good thing or a positive thing. Look, bear markets are very big opportunities indeed. What happens in bull markets, when markets are rising, you tend to get broad participation, but very few are able to cope with significant corrections. And in fact, even if it becomes an established bear market, for instance, if you bought stocks in 1929, it was 25 years before you started making a profit. So things can go down for substantial periods or fall so quickly to such a degree that it takes quite a long time for markets to come back. I am not suggesting that in the current environment. In the current environment, all I'm suggesting is we need to be a lot more careful than what some of the media headlines or some of the other people out there selling various get-rich-quick schemes might be suggesting to you. So I guess I'm trying and keep our clients safe and make you aware that there are risks. I apologize if I've overdone that at times, but I think it will be helpful to you in the long term to be more aware of risks than to not be. And also be aware that, for instance, the Kennedy family in 1929, rumor has it, they sold their stocks before the crash. And then they were able to buy property at 10 cents on the dollar after the crash. And that's how the Kennedy family moved from being a middle-class family to one of the wealthiest families in America, and obviously on to presidential and a heavy political presence in that country. It's an extreme example, but it's an example of how market corrections can be an opportunity for what I've called before relative net worth gain. For instance, when you buy your first home, you're a peg in a moving wall. So if you sell that home, whenever you sell it, you can move sideways to a similar valued property. It doesn't matter whether the property market goes up or down, you've got a sort of place where you now hold. And it's only when you have investment properties that you can actually really benefit from increase in prices. And it's a little bit similar in the stock market in that if you participate in a bull market, but you get out and protect some of that wealth at the right time and the market falls, then you can buy back in at a lower level. But also the relative wealth of your competitors has fallen, but yours hasn't. So that's your relative net wealth gain that can be very encouraging indeed. In terms of the economics at the moment, not a lot has changed. The United States is not all rosy. Omicron is the story of the moment. Omicron is a catalyst for, I think, exposing the fault lines in the US economy generally and globally in terms of ongoing rolling supply chain disruption, extenuating inflation, and really just a slowdown from the initial post-pandemic boom was already in place before this latest Omicron concern. The Omicron situation is going to, as we all know, this is not news, it's going to be very large numbers of cases indeed. The worry is it could be large numbers of hospitalizations as a result. And while some political leaders, particularly in Australia, are talking about it's only ICU numbers that matter, it actually is hospitalization numbers that matter because the health system has to be able to cope. So do keep an eye on those. They're very low at the moment, so not really that concerning. What is concerning is that we could pretty much all get Omicron, vaccinated or unvaccinated, and it is an illness that can create fatigue and feeling quite unwell for several days to 2 weeks. So do be mindful of that and do be careful over the holiday period. In terms of market price action, we've seen very strong gains in stocks. I did say yesterday morning the market was due for a firm bounce, and that's what we've had. And I do think that it is just that, a bounce. And I said on AusBiz yesterday, anything above 7350 in the US 200, anything above 7350 is good selling territory. And I continue to suggest that. I continue to suggest the Australian dollar is on its way to 65 cents next year, perhaps lower. And I do think gold is a steady accumulation market. Much of that you've heard from me before, but I did want to say it again. I wouldn't get, what I'm trying to say is, don't get too carried away about the one-day rally in US stocks at the moment and the Australian market. I'm not sure they are rallies that will last very much longer, maybe another 12 to 24 hours. But I really do think the run into the holidays will see a peak. And during the holiday season, I am feeling that equity markets could be subdued. There's going to be plenty of trading opportunities. In fact, a great way to make money at the moment is the intraday trends. They seem to be quite reliable. If you're a very active trader and you're looking at the 5-minute chart, you can just use all of your usual technical analysis tools on that 5-minute chart, because we are seeing rather strong intraday trend processes develop, and they can be an opportunity, all of their own. So there's lots to do as a trader and investor at the moment. In the micro, you can be very active and profitable, but I do think sort of trading from day to day we're outside of that daily range and catching that internal trend. You're trying to pick the movement over the next 3 days. That can be a little bit fraught with danger at the moment. If you're looking at the medium to long-term outlook though, I'd still suggest that these equity markets are vulnerable to further downside going into 2022. Please do be careful about that possibility. Create strategies in advance of what CFDs or financial instruments you could use to protect at least part of your portfolio. It doesn't mean you bail out of everything. You just protect a part of your portfolio that could give you an advantage going forward into 2022 and therefore a more prosperous 2022. Wishing you all the best. Clifford Bennett, Chief Economist, ACY Securities. Thank you very much for listening in.